Okay, so let's continue and expand on that very first video. We agreed from the video you just watched, video 2, that assets are equal to capital plus liabilities. And we just talked about this example of, here we are, money in the bank, 10,000 being equal, sorry, well, a total of 50,000 actually being equal to 10,000 coming from the owner and 40,000 pounds coming from a bank, for example. So this is a bank loan, and this is what the, 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 the owner has lent the business. Right, and I guess the purpose of any business is to take this money in the bank. Here is the money. This is really important. This is the money. That's the money you're seeing right now. This is just an acknowledgement, a piece of paper saying that, we owe this, and this is another piece of paper saying that we owe. So the equation itself, this is the equation, but if you're looking for where the actual money is, here's the money in the bank. Now, the business, if you like, is about enterprise. It's not, unless the business is a bank, and even if it was a bank, the aim of banks are to lend this money out to make more money. But the key point, let's focus on business, is to trade with this money. So the aim is to use this money to convert this money into other assets, and then to sell those assets for a higher amount than what you originally have here. And then, if you like, to make what's referred to ultimately as profit. So this 50,000, let's just argue that this is going to be used to buy a sort of machine that will churn out products, and then we make our profit. What would happen next is that this 50,000, some of this money would be used to buy, for example, a machine. Let's pretend we buy a machine. So if we buy a machine worth 15,000 pounds and we pay by check, well, what must happen is that we have a situation where 15,000 pounds comes out of the bank, but we have acquired a machine worth 15,000 pounds. So our new accounting equation looks like this. We have bank, 35,000, machine, 15,000, and all of this is still equal to this idea of, sorry, that's 40,000. Oops, sorry. Right, and this, of course, is all still, this, of course, is equal to all of this. And you can see the equation remains balanced. Right, the equation remains balanced. So we've bought a machine, and we could have bought a house. It doesn't really matter. The key point is that we have used the money in the bank to acquire something we need for the business. Okay, right. So this comes to our first learning objective, which we want to satisfy. One of the learning objectives was, what is capital expenditure and what is capital income? Well, my friends, this is capital income, and this machine here is capital expenditure. So what does that mean? Capital income is where a business acquires funding. So any money that comes, or any money that is borrowed by the business in order to buy capital, if you like, expenses like machines, a building, computers, in order to generate further income or profit, if you like. So again, if you were to give examples of capital income, you would say, oh, capital income is a bank loan. Capital income is money invested or borrowed from the owner. So capital, or money borrowed from other owners or other friends and family. And that's what's referred to as capital income. And when you're talking about capital expenditure, we're talking about, well, if we buy a machine, or if we buy, chairs and furniture that we need. The key point here is that these things that we have done are for the long term interest of the business. We're borrowing this money. We don't intend to pay it immediately. The key point is we need to set up the business. We need to buy certain capital, certain big, expenses that we will need for the long run. Okay, so what we have done, if you like, is to let's just clarify what we're saying here. We have said that we have what's referred to as the accounting equation. Assets are equal to capital plus liabilities. The main aim of trying to get this, the purpose of the end product of assets, if you like, we had to start off with some capital and some liabilities. We needed capital income. That's what capital income is, these two. We get our assets, we get the money, we transfer that money straight away into buying some capital expenditure. So for example, a barber shop. We buy our chairs, we buy our mirrors, we buy our, if you like, the building. Those are all capital expenses, and our capital income is the money we have borrowed from the owner and bank loan from the bank. Okay, great stuff, and I will see you in the next video.